Hi everyone, welcome to Financial Reporting. Myself, Dr. K. Kiran Kumar. In this video session, I am going to discuss the one of the important topic that is non-current assets. According to the IFRS5, it clearly defines the purpose and the classification of held for sale given clearly and instructions. Under this, we are going to first understand the meaning of non-current assets held for sale as per IFRS 1. It says that a non-current assets or disposal group should be classified as held for sale if its carrying amount will be recovered primarily through a sale transaction rather than through continuing use. So here we should understand one thing. If it is carrying amount will be recovered, that is the main important thing which we need to understand from this definition. Carrying amount should be recovered primarily through a sale transaction instead of continuing use. And a disposal group is a group of assets that the entity intends to dispose of in a single transaction. So in case if there might be some group of assets maintained by the company, if only one asset intends to be disposed, that is separated or ready to go for sale of the asset, this also will come under the concept of IFRS 5. Why? Because there is a chances of creating a transaction. That is the reason here, whenever company decided to go for sell any part of the machinery, instead of going with a group of assets, any one small part of machinery or asset, this can be also treated as a held for sale. Now, there are some important things need to be considered before going to identify whether it is ready for sale or not. Once all these points fulfilled by the asset, by the company, then only we can consider it as a held for sale. So the first important thing is the item is available for immediate sale in its present condition. So here the first important word is immediate sale. When the asset is ready for immediate sale. Second one, the sale is highly probable. It should be happen and it should be done within 1 year. Third one, management is committed to a plan to sell the item. So, company management should also accept and committed that they are ready to go for sell the machinery until unless it cannot be treated as a held for sale. Fourth point, an active program to locate a buyer has been initiated. Here, company should also locate the buyer or else buyer should initiate until unless it cannot be. Next, the item is being actively marketed at a reasonable price in relation to its current fair value. It means whatever the company is ready to sell their machinery, the price should be related to current fair value or else based on the market value. Otherwise, the asset should not offer more than the market value or else less than the market value. Let me give example. After usage of the asset for 5 years, which is the cost of 30,000 asset, company may go for 25,000 rupees after depreciating. And comparing to the market, the actual value of the machinery is 27,000. So with this regard, company either can go for sell the asset 27,000 or is 25,000. Why? Because your depreciation should be calculated and reduced from the main asset value. So that They can compare with the market, is it more or less to identify. Next, the sale is expected to be completed within 1 year. As I already told you at the beginning, the process should be done or completed within 1 year. Otherwise, cannot be treated as a held for sale. And last one, it is unlikely that the plan will change significantly or be withdrawn. That means once the management committed for sale of any asset, it should not be withdrawn. That means once they decided it should happen, there is no chances of cancellation or withdrawn with regard to the sale of asset. So these are the 7 important points need to be fulfilled by the company. Next, measurement of non-current assets held for sale. So of course, sale measurement process, carrying amount and fair value. Non-current assets that qualify as held for sale should be measured. This is very, very important. How to measure the non-current assets means there are two things. One thing is here, carrying amount, where carrying amount lower than the sale. And the second one, fair value less cost to sell. If any expenses incurred for sale of asset, those costs can also be available. First one is carrying amount, should identify carrying amount. After that, if anything is required to add for sale of asset, they can reduce. Next, held for sale, non-current assets should be presented separately on the face of the statement of financial position under current assets. So this value can be shown under current assets and not a depreciated value. Now let us understand the concept clearly with the following example. On 1st January 2001, Mitchell company bought a stamping machine for $20,000. It has an expected useful life of 10 years and no residual value. So very simple. The machinery cost is 20,000. Useful life of the asset is 10 years. And what happened on 30th September 2003, Mitchell company decided to sell the machinery and start action to locate a buyer. Have you observed when the company bought the machinery 2001 and when the company decided to go for sell 2003 on 30th September. So almost 2 years, 9 months. So for 2 years, 9 months, we are supposed to calculate the depreciation. The machines are in short supply, so Mitchell company is confident that the machine will be sold fairly quickly. Its market value at the 30th September is 13,500. And one more important thing, 2001 company bought $20,000. And after 2 years, 9 months, company identified the market value of the same machine is $13,500. And if you sell, the cost incurred is $500 to this one. So this is the clear information with regard to the machinery of the Mitchell company. So first, what we are supposed to do, we should calculate the depreciation for 2 years, 9 months. And the same depreciation amount will be deducted from the machinery cost, that is $20,000. And we can compare with the market value. Is it more than the market value or less than the market value? So this is the answer. Machinery cost is 20,000. First year depreciation 2,000. Second year depreciation 2,000. Third year depreciation for 9 months 1,500. So after deducting depreciation from the machinery cost, the book value of the machinery is 14,500. And if you compare with the fair value, here we are supposed to identify and compare with the fair value. So fair value is here, that means market value 13,500 and the cost to sell is 500. So total 13,500. 13,000. Have you observed what is the book value here? 14,500. And the fair value is 30,000. So the mission qualifies, of course, as per the held for sale, IFRS5, on 30th September 2003. So should be stated at the lower of 14,500 and 13,000. So namely at 13,000. So whichever is lower. As per the calculation, the missionary cost is 14,500 after deducting the depreciation. But in the market, when compared to the market, our current market value, it is 13,000. So 13,000 amount is going to be shown under the balance sheet. So as per the rule, whichever is low, so same amount only shown under balance sheet. And in the impairment loss, whatever we got, what is the difference actually as per the calculation? 1,500. Incurred in writing down the mission to fair value less to sell will be charged to the statement of profit and loss account. So this 1,500 going to be shown under profit and loss account. So this is about the IFRS5 non-current assets for the product sale. Thank you so much. Have a nice day. Again, we will discuss the another important topic in next coming video.